Welcome to live market coverage on Yahoo Finance. I'm Seana Smith. We have stocks rallying today following news that the coronavirus outbreak seems to be peaking in some of the hardest hit areas around the world. Now, investors are keeping a close eye on the numbers out of Europe, where the pace of new confirmed infections and number of deaths are slowing in some regions. Sector-wise today, we are seeing all 11 sectors move to the upside, led by gains in utilities, consumer discretionary, and also materials. As it stands right now, we have the Dow up over 1,200 points, so well above 22,000. So here for more on this, I want to bring in Brian Levitt of Invesco Global Market Strategist. And Brian, let's start with the rally that we're seeing today in the markets. Like I said, the Dow up over 1,200 points as it stands with just around 2 hours left in the trading day. From your perspective, we're trying to dig through, not read too much into each day's moves, but do you think we've turned some sort of a corner at this point?
Well, I think it's reflective that markets don't trade on good or bad. They trade on whether things are getting better or worse. And so we're all sitting here now trying to assess whether things are getting better. I wouldn't put too much stock into one day's move. I mean, the volatility index is still very elevated, so we should expect continued swings in markets. This is just, couple of weeks or a week ago, we got a good response from policy. This is the first time in a while we're getting a little bit positive news on cases. It's certainly not in all clear, but the markets are rallying on a little bit of signs of better news.
Brent, I know you're saying it's not the all clear, but we haven't touched the lows or the lows in the market we saw back on March 23rd. Do you think we'll likely retest that low, or has the market priced in most, if not all, of the bad news that's to come at this point?
History usually suggests that you retest lower levels. So if you're going to follow a pattern that we saw in '87 or 2008, you may retest lower levels. What I'm trying to watch are some of the leading cycle indicators that I still have some concerns about. I mean, by now, I would like to see some of the indicators around inflation looking a little bit better. The 2-year rate's still very low. Copper's still very low. The dollar's still strong. You'd like to see commodity prices improve, high yield spreads come in. So we need all of those to work together until we get to a better place. But, stocks will put in some days like these. It's a process, and we'll have to go through this process.
Hey, Brian, when we last spoke a couple weeks ago, you were saying that the policy action was helping us move away from what you called the worst case scenario. Do you think that's still the case at this point, or do you think investors want to see what could be a phase 4 type of deal come out of Washington?
So I think there's two different questions there. The first one is, yes, we have walked away from the worst case scenario. And so the market's priced in, 30-something% decline is pricing in a recession. Then you assess, do we need to price in a financial crisis, or dare we even say a depression? And because we have lived through a Great Depression, and because we lived through 2008, policy responded very, very aggressively. And that, in my opinion, takes off the worst case scenario. But there's probably more policy support to come. I mean, what we've done with a couple of $1 trillion is provide some cushion, but we still don't know how long this extends. And there's high demand for small business loans, and there's municipalities that probably need support. So I suspect that there is another phase of fiscal stimulus coming. But that's what's important for investors. I mean, again, I come back to my original comments. Markets trade on whether things are getting better, and policy support should help to continue to make things better. So is it going to still be volatile? Sure. Could we retest lower levels? Yes. But I suspect a year from now, markets are positive, higher from where we are today.
Brian, what type of recovery are you expecting to see? There's lots of debate out there. I think the consensus now, and majority think that we will see some sort of V-shaped recovery. Others, though, are saying we're going to have a guest later on in the show who says that we could be seeing an L-shaped recovery. But what are you expecting at this point?
Well, I think it's a little bit too optimistic to say a significant V recovery given where unemployment is going. And so the fiscal stimulus provides some cushion and hopefully helps you get some demand on the other end of this. But Sean, I think what's most important for investors is you don't necessarily need a V-shaped for a strong market performance. If we think back where we were in '08 or '09, we were talking about mortgage defaults that hadn't even peaked yet, an ongoing deleveraging environment for households, And so you ended up with a pretty weak recovery, and yet that weak recovery ended up being good for the markets because it was growth that was enough to support corporate earnings, but not so strong to bring forward inflation and Fed tightening and that type. So I wouldn't get too worried about, from a market perspective, about the shape of it, so long as we trough and the economy starts to to modestly improve. That should be a good sign for markets. The market should stick that out.
Yeah, Brian, one of your recent notes, it was interesting. I was going through some of your recent market commentary, and one was titled that a volatile market may be the time to act against your instincts. What exactly do you mean by that?
Yeah, I mean, it's the old Seinfeld line: if every instinct you have is wrong, then do the opposite. And I think far too often investors try to time these things, and it really is a fool's errand. And the time to be defensive was likely was 2-3 months ago. Investors now flocking to cash, that doesn't typically work. Even if we're not all the way through this downturn, what our statistics found, our analysis found, is you're better off investing halfway through it and then getting the recovery than waiting a year out or waiting for the economic data to get better. It just doesn't work. And we also know if you miss the best days in the market, your returns are impaired significantly over time. Today's likely to be another one. I mean, something like 80% of the best days happen either in the bear market or the first 2 months out of it. And so it's very, very difficult to time. So let's push back against our instincts.
All right, Brian Levitt of Invesco, thanks so much for taking the time today.
Thanks, Shauna. Appreciate it.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.